Hello. In our last video for Chapter 10, I want to talk about pages 1015 through 1019. When the partnership has a profit, hopefully, okay, obviously what they want to do is they want to distribute some money to the partners, all right? And if there is no plan in place to give one or more of the partners any money in advance, okay, then the partners will just distribute money as they see fit, and this is called a current distribution. However, one or more of the partners, okay, might be exerting significant influence over the partnership. Okay, and that partner may ask for or demand a guaranteed payment no matter what happens to the partnership, whether the partnership has income for the year or a loss. So a guaranteed payment is a payment made to the partner, all right, regardless of whether or not there is any kind of a profit for the partnership that year. All right, that guaranteed payment is treated as an ordinary business expense on the financial statements, all right, and is treated as a payment to the partner and is taken as a deduction on page 1 of Form 1065 and is reported separately on Schedule K1. If you go back and look at it, all right, there it is, the Schedule K1, line 4. All right, guaranteed payment to partner. All right, and that guaranteed payment would be reported on that partner's K1. Unlike the other lines, which are usually split up by the percent of ownership in the partnership. All right, the guaranteed payment has to pass through only to the partner that received the distribution of assets. Okay, so that's what a guaranteed payment is, and that is discussed at the bottom of page 1015. All right, probably going to see that on the quiz, probably going to see that on the next test. Okay, so know your guaranteed payments. All right, they're very, very common with partnerships. Okay, especially when you have a partnership where one person is contributing more to the partnership either through services or assets or brain power, whatever, than the other partners. All right, so that's a guaranteed payment. All right, guaranteed payments are treated as ordinary income to the partner that is receiving it. All right, on top of page 1016, all right, there is a short discussion about tax years. All right, generally when you first file for your EIN with the IRS and you tell the IRS that you are a partnership, you first obviously have to tell them what you are. Okay, the by default, all right, your partnership year will end in December. All right, unless you can give a really good reason why it shouldn't. Now, we know that retailers tend to end their year in January, all right, but then again, most retailers are formed as corporations, not as partnerships. All right, most of your partnerships are usually service companies. All right, they are doctors, they are CPAs, they're attorneys, okay, all right, and those companies, all right, generally will end their year in December. Okay, so basically it says that the partnership has to have a tax year that is commensurate with the most of the partners' tax years. So if you have 10 partners and 8 of those partners are individuals who end their year in December, that means that the partnership has to end their year in December also. All right, you will have a question on your quiz involving transactions between partners and partnerships. All right, basically, if the partners own 50% or less in the partnership, then any transaction is treated just like any other ordinary transaction. All right, so if one partner sells, property, let's say with an adjusted basis of $50,000, and they sell it to the partnership for $45,000, they could take a loss of $5,000 on their tax return. Of course, they would be limited to $3,000 on the current return, and the other $2,000 would pass through to any future return. However, if one of the partners owns more than 50%, then the losses are disallowed. All right, so if you take a look at the top of page 1017, all right, it says Kyle owns 55% of Willow Interest. All right, during the current year, Kyle sells property to the partnership for $60,000, and his adjusted basis in the property was $75,000. So that means that Kyle had a loss of $15,000. But because Kyle owns more than 50% of the partnership, the $15,000 loss, all right, is disallowed. All right. Now, the loss can be used later, all right, if the partnership sells the property, all right, for more than the adjusted basis of the property when it was first brought into the partnership. So in other words, that loss is going to be on hold until that property is sold, and if the property is never sold, then the partner will never realize any kind of a loss. And this, again, this is only because we have related parties. In other words, the partner is related to the partnership itself. Okay. All right. The bottom of page 1017 is the at-risk rule. I'm not going to really worry about that too much. You can read up on that. So we're going to end the chapter on page 1019. Okay, there is a lot of misconceptions about limited liability companies. All right, a limited liability company is a legal entity. It's not a tax entity. All right, I get people all the time that say, well, I want to file an LLC return. And I tell them there is no such tax return. All right, an LLC, all right, is created when you are trying to have limited liability, all right, and protection from whatever it is you're doing. So, for example, a landlord might set up a legal entity, an LLC, for each one of their rental properties. So if they have 10 rental properties, they might set up 10 LLCs. All right, that way if something happens and they get sued, they would only lose that one house and they would get to keep the other 9. If they put all 10 properties in one LLC, they could lose all 10 properties. Okay, but the LLC doesn't determine what kind of a tax return that you file. So for example, if you are a single individual, okay, if you are a single individual, you can file a Schedule C, all right, or you could be incorporated, and you can still be an LLC. So a one-person LLC can file a Schedule C, or can file a corporate return, which we will talk about next week in Chapter 11. 2 or more people, and if they want to form an LLC or an LLP, a limited liability partnership, they could file a partnership return, or they could file a corporation return or a corporate return. All right, it'll tell you on page 1019 that most limited liability companies, since there's usually more than one person involved, are usually set up as partnerships. All right, okay, so you could have an LLC and they can file a Form 1065 with no problem. If they get sued, they will just go back and go, hey, we're an LLC, you can only sue us for our for our basis in the partnership. They cannot be sued for their personal assets. All right, so remember, an LLC is a legal entity only. It is not a tax entity. Okay, that concludes our videos for Chapter 10.